Hey guys, this is Bob and Phil, Trade Genius. Welcome to our podcast. After today, you may not want to own stocks for a while. Stay tuned. We have math to back up Bob and Phil's doom portfolio. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Okay, Phil, you and I have been dooming it. People are saying, Bob, you guys are a bunch of doom brothers.
Bunch of doomers.
But we're gonna show the math here, guys. Okay, and that's all we ever care about. We're math-based traders. You know, you're whistling past the graveyard if you think a new bull market's coming. Phil, you kind of dug these charts up. Why don't you kick it off, and then we'll see where this thing goes.
Yeah, so we got about like 4 charts. We'll just run through them here over the next few minutes just to kind of give you guys an idea of what is going on here. This first chart, basically what you want to look at is that lower half of the graph, which is essentially what the price to sales ratio is for the S&P 500. If you look at what happened after 2000, okay, that's going to represent the dot-com crash, and it's indexed there from 0 to 100 in a percentile scale. And you'll notice that that ratio, price to sales ratio, heads toward 20% as we go into recession, essentially. And then you can look at that as well as we kind of went down into 08, 09, just before 2010 there on the chart. Again, percentiles at that point went under 10%. So here we are hanging out, over 80, almost 90% percentile in that category. And if you look at it in terms of we're going into a recession, then you have to look at those drops in the graph there, between 2000 and 2005, and then shortly before 2010 there on the graph. You can see we're miles and miles and miles away from where we could be as we go into a recession. So that's one example of why things are way overvalued here. So another one, and Bob, this is kind of like your department with PE ratios and things like that. This one here basically tells us that in 2009, which is represented by that copper line, okay, what it's saying there is that 40% of the stocks, okay, had a PE ratio of less than 10. So the PE ratio is the row on the bottom, okay? So almost 40% or 40% of the stocks had a PE ratio of 10 or less. Now, if you look at that today, and that's represented by the black line, most of our stocks have PE ratios of 20 or higher, okay? Majority of them are somewhere around 20 though. So again, we're like twice as high than we would be if we go into a recession, because if we go into a recession, trust me, the numbers don't lie historically. We're going to go back to these levels. So you're going to see a lot of stocks with a PE ratio south of 10. Okay, so there's another example. Then we can look at earnings. And Bob, we've seen the earnings and the guidance, the forward-looking guidance has not been good. This chart here, if you look at the black lines heading kind of toward that baseline of 100. So they've indexed earnings basically from 75 to 110 on the scale here. So 100, once you start going under 100 on that reading, it typically confirms recession. So as each quarter, we've been dropping in earnings overall that we've been getting, right? So we just went through another round of earnings. So here we're at basically our index of 100, which implies that if the trend continues next quarter, we're going to see earnings dipping under this index of 100, and that's going to confirm recession, okay? And this is what this is telling you, is that those earning numbers are typically after they've said, okay, because recessions are backward looking, right? They'll tell you, oh, we entered recession in May or June. So you're going to have those earnings basically confirm recession that may have started a month or two prior.
So what people don't realize is that you have 25% of the S&P 500 that earn nothing. You have 40% of the Russell 2000 that earn nothing. So between 2009 and 2023, we basically allowed non-profitable companies to go public. So Wall Street basically scammed all of us, and they dumped out stocks that they normally have to babysit, and they'll get less of a return. But what they did was they pushed it out into the marketplace and created a bull market here with the lower interest rates and pushed all really garbage stocks out to us. Now, when Phil's showing you that earnings thing going to zero, that's for companies actually with earnings. So when you can't maintain a price to sales ratio in a recession, that falls. And these companies now are going to have to be able to make it on their own, but they have to borrow every month to stay alive. And basically their cost of capital went up 5x in the last 12 months. So we have just a perfect crap storm here, Phil, coming at us. So, when you look at this market, is that basically, and these companies won't all go out of business. What they'll have to do is they'll have to dilute their shares, which means their share values will fall significantly, basically to pay off the loans. In fact, the banks will demand it as we go into recession because the banks don't want to be held with bad debt. So they're going to force these guys to do basically raises of share amounts. And that's going to cause a dilution, which is just going to drive the whole market down. I mean, you're talking some big companies, too, that aren't making any money, too, Phil.
Nope.
So there's a reason why this market's been up this way, and they know it. They're scared witless, Phil, to let this thing start, because once this dam breaks, you're looking at probably 10 or 15% of the stock market. The companies in the stock market will be gone. So pretty scary stuff.
It is. And I was listening to some old bond traders were talking the other day, and they were saying it's funny because this market really is complacent considering how much the Fed's hiking and will continue to hike through the year. Like the bond guys know they're not going to stop. I mean, they're going to hike 25 basis points from here until December. And maybe you might get a little bit more too into 2024. But they were like, man, this market is so complacent because historically, when you've hiked this much, this fast, things start to break. And I know you've really banged on that with these companies that aren't profitable, that are basically operating on debt. And I think they run out of rope here real quick in the next quarter. So that's really bad. So then to wrap this up, guys, the rule of 20 is basically, it states that over the long term, your PE ratio and the inflation rate should sum to 20. So if you're over that, which just on PE ratios alone, we've been way over, the market is said to be overvalued. Now, a lot of that was because the Fed's been, pumping money into the market, and we all realize that. So of course, you're going to have higher PE ratios. But let's say, okay, now that the Fed's basically taken away the punch bowl from the dance, and now we have to look at, things standing on their own, and now we have rising inflation, that makes this market all the more overpriced. So what you want is basically a market that doesn't go over 20 in that calculation. And unfortunately, today we're way over that by 25%. And if you look at how that looks on a chart, which is this chart right here, black is where we are. S&P 500. That copper line in that circle is where that rule of 20 value is. And that implies that we should be trading down toward 3,000. Now, we've shown you guys on the liquidity chart, we're about 300 points over fair value as of last Friday. So, we could be down to 3,600 and then 3,000 is only 600 points lower. And of course, it's not going to be in a straight line. We'll have ebbs and flows as we go through the typical seasonalities in this year. But you can see with these charts and with the number of examples that we've shown you where recession is really highly likely, considering the data that's coming in, we could be trading at 3,000 later this year easily. So are stocks overpriced here? In view of all this, yeah, we think they're really overpriced. So you really want to have your powder dry. And that's where this thing is going to get interesting. We're going to get into these areas or these pockets where we're going to have favorable bounces. And we can talk about those times when we get in there and the headlines will change from, look out below to, hey, we're going to bounce for a month or two. And so that's just the ebb and flow of the market. And all we want to do is kind of keep you guys abreast of the reality of it and not just what you want to hear.
Yeah, I think we laid the case out, guys. We're giving it to the jury. You guys decide.
Yeah. So let us know your thoughts. What do you think? You want to buy here? You want to wait? And if you do want to wait, how much lower do you want to see the market go? Would be interested to hear what your thoughts are on those levels. All right, well, that's going to do it for this episode. Thanks for watching. We'll see you on the next one. Please hit like and subscribe, and also check out our website, tradegenius.co. We've got our specials and a newsletter on sale there as well. You can check that out. Talk to you later.
Trade Genius.